You know, about to do what? Walk in that door.
Woo! Hi, guys.
Become the next level leader you aspire to be with a doctorate from Franklin University. Choose from programs in business, healthcare, and education. And finish your doctorate 100% online in as few as 3 years. With Franklin's no-fear dissertation. Learn more at franklin.edu.
Okay, it won't let me escape. No, okay.
The $5 meal deal at McDonald's means you get to pick.
Thanks for enjoying my commercial.
Then get a small fry.
It's still sharing your music.
I know.
And a 4-piece McNuggets.
All right. Hope you guys enjoyed that. I promise you guys I will figure out how to do this Zoom thing one day.
You're fine, Shelly. You're fine.
Thank you. You're sharing screen, right?
Yes.
Okay. Hi, everyone. I haven't seen everybody in a long time. We skipped last Zoom call, so it's been a month since we've seen everyone. Happy Wednesday. Welcome to our Multifamily Freedom Chasers Debt Financing Zoom call. My name is Shelly Miles. I am an author, a commercial mortgage broker, and a co-founder of our brokerage company, Adventure Commercial Capital. Together with Mr. Jerry Miles over there. What our company does at Adventure Commercial Capital is connect real estate investors like yourself to lenders. And with that, I don't recognize everybody's name. If you guys are new, can you let me know with a 1 in the chat so I can say hi? While you guys do that, I'm going to tell you today's agenda. We're going to go through our ecosystem if you guys are new, and you guys will hear all about that. And we're going to do some introductions on who we are, and then we're going to do, give you guys an opportunity to introduce yourself. And then we're going to give a current debt market update, and then we're going to get to our main topic, which is how will the Fed decision that they made today will affect lending. And also we'll have a Q&A at the end. Let me see. Let me check my chat. Okay. I guess everybody has been here before. Okay. So we have a community system like no other. We have 4 Zoom calls that we do, and it's alternating. It's only on Mondays and Wednesdays. So the first Zoom call we have, you can see it on the screen there. It started with Marcel, Trevor, and Victor, the 3 guys on the left. And on Mondays, on alternating Monday, you'll get Trevor. He does the activation Zoom. You can get activated with them for the week with a celebrity guest speaker. Is somebody trying to say something?
No, I don't think so. Good. Keep going.
Okay. Sorry, where was I? Yeah, you can get activated with Trevor on Monday nights with a celebrity guest speaker. On the alternating Monday, you have asset management with BB and Iffy. When you close a deal, what now, right? So the real work begins. You will learn the fundamental, explore real life scenarios, challenges, solutions for your multifamily operation. And then on Wednesday, you'll have us. This Wednesday is us, and next Wednesday is Ed and Kevin. With us, you're going to get the financing part of your multifamily deal. You'll get live updates on the current debt market, and you'll learn what it takes to find and qualify for debt to take down big multifamily deals. Then you'll have deal sourcing and underwriting with Ed and Kevin, the alternating Wednesday. So we're today, and then next Wednesday is Ed and Kevin. You'll learn how to engage with brokers, source deals, and underwrite them quickly and efficiently with Ed and Kevin. Also, next Monday, I think we don't have a Zoom call, so that's like an off week. Trevor's not having a Zoom call, so our next Multifamily Freedom Chaser Zoom call will be next Wednesday, a week from now. All right, move on. You can also plug into our Multifamily Freedom Chasers ecosystem through YouTube. You can get all the recordings of all these Zooms that we do on Mondays and Wednesdays. You can go back to previous ones and look. You can look at the one we're doing tonight. Actually, probably tomorrow. They do a pretty good job of putting it up on on YouTube. We do Spotify. You can connect with us on Facebook and Instagram, and I will share the WhatsApp link. Why do we not have that WhatsApp link up front? I don't understand why I keep putting it at the end. I will switch that next time, and you guys will have the WhatsApp link where you can join our WhatsApp group as well. Let me put the link to the Facebook. If you haven't joined our Facebook community yet, I suggest that you do, because you get all the updates and all the schedule and reminders for all the Zoom calls that I just mentioned. Yep. And that's it. Do you want to take over?
Yep, I
Mr.
will.
Miles?
Hello, everybody, and welcome this evening. I'm Jerry Miles, and that is me and my wife there in the picture, along with two of our boys. JJ had just graduated last year, and Jordan is a freshman this year. We are commercial mortgage brokers, co-founders of Venture Commercial Capital. We started this business, what is it, about 5 years ago now?
Yes.
We've been in business for ourselves for over 20 years. We've run a commercial roofing business for the last 20 years. About 10 years ago, started investing in real estate, and through our real estate investing, saw a need for a lending broker that is honest and there to service the clients and help them grow their portfolios, and not just there to take fees and wipe people out as much as they can. We're here to grow with you and help you along the way. So that's why we started this business. So anybody
Also, can I say something?
Yeah.
So the Zoom calls that we're doing here on the Multifamily Freedom Chasers are not just for educational. We're here to connect with each other too. So feel free, I saw some of you already did it already, to put your information in the chat so you can connect with each other. And you can put your markets on there too, if you guys are looking and have specific markets that you're looking in.
There you go.
And build a team.
Awesome.
And if you want to turn your Zooms on so I can see your face, that will be easy too. Thanks.
So we have seen several different people have been able to connect on our calls here and do business together. So definitely, I recommend people letting people know who you are. As Grant Cardone says, if they don't know you, they can't flow you. So get out and let people know who you are, and tell them a little bit about yourself. Probably got time for 2 or 3 people to give us about a minute each. Tell us where you're from, a little bit about you and what you do in real estate.
Yeah, and you don't have to be new to raise your hand to come up and speak for a minute. Anybody can. It doesn't matter.
If anybody wants to, just raise your digital hand and bring you up and let you say a few words.
It's one of the best ways to connect with everybody.
Our son JJ used to. Hey, there's Eric. Our son JJ is usually on here, and he's always the first one to raise his hand to tell us about himself.
He's gotten too big for us. He can't jump on our Zoom calls anymore.
I see Eric. Go ahead, Eric.
Well, first of all, I really appreciate you guys holding these calls. Not just you guys, but the entire Multifamily Freedom Chaser network. It's very beneficial. I've been on more than a few of these calls now, and I've always been in a really quiet spot. So now I'm in a place where I can talk. But I'm Eric Manton. I'm actually in Boise, Idaho. It's a neat market right now. It's a lot of new construction going up. There's a highway expansion going in, and a lot of growth happening really quick. So Imagine Phoenix about 35 years ago. You have Boise right now, kind of that same pattern. But as far as I'm still learning the multifamily space, I'm doing a little bit of wholesaling here in the area as well too, and that's kind of been interesting. But yeah, I'm just still very much a learner. So all of this is very much appreciated and right in alignment. So thank you.
Awesome. Well, good to have you here. Thanks for being the first one to raise your hand.
Yeah.
Yeah. Michael. How's it going, sir?
Oh, fantastic, guys. So yeah, I'm from Las Vegas, Nevada. New to the whole real estate investing thing. I just got some money at Grant, but looking to take advantage of the opportunity that we got in front of us here. My background is in commercial insurance, so I, can help with the quoting and stuff like that. So that's the forte I have in the field. So just looking to hopefully find a great property and get our first deal.
Awesome. And you do insurance on just Nevada properties, or do you work all
No,
50 states, or?
I'm in Nevada, California, Arizona, Utah, Washington, Wisconsin, Texas, and Colorado now, and Minnesota, I believe. It's like 10 states right now.
Awesome.
Yeah.
Awesome. Yeah, and I've got people always asking for insurance people. So
Awesome. Yeah, I'll drop my digital card in the chat too.
okay, for sure. And towards the end here, we'll be putting up a QR code to connect with a Hi Hello card. So definitely do that, and then it'll put your information in my phone. So
Perfect.
yeah, thanks for being here.
Absolutely. Thanks for what you guys do.
Yeah. All righty. So I'm going to go ahead and move on to the current debt market. There's a lot going on in the market. If y'all didn't know, the Fed finally did their first rate cut. They've been talking about it for a year, maybe more than a year, about, hey, we're going to cut, we're going to cut, we're going to cut. And then they just keep pushing it out. I feel like it's been more than a year they've been doing that. But today they cut rates 50 basis points, also released their projections for the next several years, what they see to be happening with the federal funds rate over the next several years. We'll talk about that here towards the end. Where are the current rates? Well, up until today, we were at 5.25 to 5.5. Now we're at 4 3/4 to 5. That's the federal funds rate. 10-year treasury, we're at 3.7. A 5-year, we're at 3.4. The treasuries or the bonds, those determine the rates that we pay on a lot of our long-term debt. So when you're looking, from the bank, or whether it's CMBS or Freddie or Fannie, whoever it is that is providing long-term funding, they're going to take that treasury, and then they're going to have a spread that they add on top of that. And that's the fees that the lender or the bank is making. Anywhere from 1.25 on at the best. Sometimes you might even get some that are lending 5 points over the treasuries, depending on the deal, depending on a lot of different things. So when we're looking at, short-term debt, they're going to be looking at SOFR. You're going to be SOFR +5, +6. You're going to look at, maybe Bank of America Prime, and then you'll add, whatever the bank, the spread is over top of Bank of America Prime. And so a lot of times when you're when you're getting quotes from banks, they're soft quotes. You're not going to lock rates in until, a week or two away from closing, or even at the closing table. And a lot of times you'll see a rate, what it would be today, but then you'll see 10-year, the 5-year, 7-year, 3-year, whatever the treasury that they're looking at. And then you'll see what the spreads are going to be above that when you're looking at the quotes. So Freddie Mac and Fannie Mae, they lend on apartments. Probably the most attractive financing that you'll get right now is through Freddie and Fannie. Freddie Mac has their small balance program, which goes from 2 million to 7.5 million. And you know, this is the rates that you would pay on a loan, anywhere from 2 million to 7.5 million. These are the current rates. When you get above the 7.5, it goes to what they call conventional Freddie Mac. The rates will be 25 to 50 basis points lower than what you see here. This is the Fannie Mae. As you can see, they're a little lower. Fannie Mae likes the nicer locations a little better. If you're going and you have a property that's in maybe not as populated as an area or more rural, things like that, Freddie Mac a lot of times is who we'll go to for those. You know, we've been in a stagnant market over the past 2.5 years since the rates have climbed the way they did, and that's starting to break free. Well, we're at the beginning of seeing it breaking free. You know, in the current market, you know, we've seen our lender book that we have over the last 3 years. 3/4 of the lenders that we had in our lender guide that we used that of our connections with lenders and bridge lenders and all these things. About 3/4 of those companies over the last 2 years have either halted lending or just gone out of business altogether. You know, a lot of the guys that were our competitors are now driving Uber. They're, you know, they're waiting tables. They're doing a lot of different things, you know, to try to make ends meet. You know, because there is just not loans being closed right now. There's not new applications being done. A lot of the properties that have been bought over the last couple years have been on assumable debt. And so they go in and they just take over the current loan, which doesn't do anything for a mortgage broker or a lender like us. So, you know, there's people doing deals, but you know, a year ago we heard 60% of all mortgage guys and girls are going to drop out of the market and find other work, and that's happened this year. So, so we're hoping that the rates continue going this direction, and that we get busy again here. So that's what our hope is, and that people can start buying and selling deals. So, but I do believe there's a lot of deals coming to the market, a lot of deals running to the end of the maturity. You know, $2.7 trillion of debt by the end of 2027. You know, $500 billion in 2024, $500 billion in 2025. These numbers, you know, that is what is forecasted to mature at those times. Over the last 2 years, there's been, you know, $500 billion or more that has matured, that has not been refinanced, has just been put on extensions. So these are all going to be coming due at the same time as well. So there's going to be a lot of deals coming to the market here in the near future. And as you're looking for deals, it's very important to find out on these deals, you know, why are they selling? You know, is this a person that's just trying to get out of a deal? Is this a person that is coming up to the end of their debt and they have to sell? You know, you need to ask those questions, because that will let you know whether they're really going to sell or not. So how will the Fed decision affect lending? So, I don't know if anybody sat and listened to all of Jerome Powell's speech. I listened to it in pieces between phone calls. But, you know, we'll talk a little bit about it here as we go. The history of the federal funds rate. The highest recorded federal funds rate was in 1980, and that was at 20%. a lot has changed since 1980. The lowest rate recorded is 0% in 2008 and 2020. The federal funds rate has steadily decreased since 1982. It's just been a steady decrease since 1982 to 2022. I was talking to a guy. He's got a lending company based out of Manhattan. They lend on a lot of hotels. He's a big guy in the space, and he's been in the business since the 1970s. And I was talking to him on the phone today. We're doing a deal with him, and I was just kind of getting his take on things since he's been in the business so long. And he was telling me that we've had rates decreasing since 1982. And, we've even had them twice at 0 since 1982. It's not that, the 5.5% is high. It's that it's higher than what people are used to. And he's just saying that it really shocked the market that we shot up over 4% in just a few months. And it really shocked the market so bad to where everybody just stopped doing anything. And a lot of people couldn't do anything because, if you had debt at 2%, your property's not worth what it used to be right now. And you can't sell because you're going to be underwater and all these things. So there's been a lot. I mean, it's done a whole bunch of damage to the market. If things really drop fast, some people will be saved. Others, it's not going to drop fast enough for them. They're going to be losing money on deals. But how did we get here? The Fed or the Federal Reserve, trying to curb inflation. Inflation is something they've battled through history. That's why in 1982 it was at 20% because they was battling inflation through the 70s. They really put kind of the stop strip out on on the inflation. It just kind of put a brick wall in front of it and just stopped all business from happening is what they've done. So if things aren't buying and people aren't buying and selling, we still own a construction business that has gotten slower. All of our subcontractors that do work for us, they've been calling wanting work because they're all slow. Everybody's getting slow. I was telling my wife before the call that I was at a storage unit. We have a storage unit in there, and the manager was there cutting people's locks off and putting tags on the storage units. And I was asking him about the how many of them he's got to do. He said, well, usually he said I do 3 to 5 of these per month. He said, about 2 months ago, we went to double digits. And he said, we were at 10 and 11 the last 2 months. And he said, now this month, I think he said 16 of them that he was doing, that people weren't paying. So it's just a sign of the times and what they've done to the economy, trying to pull back and slow the growth down. So to slow the growth down, it's got to hurt some people, and that's what it's doing. So they're definitely pulling it back quickly. The last, I don't know how close you all pay attention to the reports that come out, the employment reports, the CPI and all these things. They come out and the reports look good. And then a few weeks later, you get what they call a revision, and you get some really bad numbers coming out. Oh, sorry, we misreported or we were off. The employment numbers, I believe it was the employment numbers this past month, was off at the biggest. It was the biggest revision that they had to make in like 35 years, which tells me they're either trying to hide something with their reporting that they don't want people to see. They don't want panic in the market, or I don't know what it is, but they're not being honest with us as they're reporting numbers. That's for sure. So the things that the Fed is projecting today, in the Fed meeting today, they said they are expecting by the end of 2024 the federal funds rate to be 4.4%, the effective federal funds rate. By the end of 2025, they're expecting 3.4. And now by the end of 2026, they're expecting 2.9. A lot of people are saying that they're never going to get to these numbers, that as the stock market went up today at the sound of the news. So as stock prices go up, other things go up, people start buying more, they get more confident in the market. Maybe the companies will hire somebody new, and things start getting better. And that's, if they continue lowering quickly, like another half a point here in the next meeting, which is what they're talking, maybe. I mean, we could go back into an inflationary period, and they're going to have to halt the rate drops again. So a lot of the experts are saying they might be going too fast. They need to slow down. Other ones are saying, oh, they've waited too long to lower them. Who knows? But it's going to be interesting to watch here over the next couple of years. It's going to be a long, drawn out process. It's not something that's going to happen overnight, as far as the repercussions of how they raised them or how they've lowered them. It's going to be a long, drawn out process. Something else I found interesting in the decision today. This was the first time that the Fed has made a decision on interest rates in the last 2 years that all the board members were not unanimous on it. So there was some board members that were saying that we need to hold off before we lower. We need to hold off to 25 basis points. We shouldn't do it to do the full half a point. So there was some disagreeing in the pack, which probably not a big deal, but it's just interesting that in 2 years' time of raising rates, every decision was unanimous and everybody agreed with the decision. This decision here, not all of the board members agreed. So you can take that, how you wish, but I thought that was interesting. It's just going to add some more fuel to the fire as we go, I think. How is how will this affect the final rates that we pay, or will it affect? Yes, eventually. The treasuries are what a lot of our lending is based on, a lot of our long-term lending. And the treasuries will usually move with the Fed rate. But the Fed made the decision today. Treasuries didn't move today. Actually, I think since the Fed made their decision, I think they actually went up. One of them went up like 7 basis points. Another like 5 basis points. So it kind of went the opposite direction. But as the treasuries, as people sell off their bonds and take profits and things like that, the treasury prices will come down. When we're looking at a half a point, that's not a lot in comparison to what they have raised rates. So I don't expect it to do a whole lot. Like this second, it's going to change a whole lot. But I think as time goes, it's going to kind of change the outlook, I think, of things and the way people are viewing, maybe their purchases and things like that. It might give the sellers that are trying to sell and hold on a little bit, it might give them a little more confidence to hold on for their pricing, which, is not good for the buyers because things are kind of overpriced for the market conditions right now. So who knows what's going to happen, but it's good. Like I said, it's going to be interesting to watch and see. And not sure if this decision is, they didn't really talk much about if we're going to go into like a quantitative tightening or loosening. That it lets us know how much money's in the market for the banks to lend. So as they tighten, the bank don't have as much money to lend. As they loosen, it allows the bank to lend more against the deposits that they have. So we'll have to wait and see on that. It's just, time will tell. But, was the decision today the right decision for the Fed? Some people say yes, some people say no. I say, who knows? Is it too big, too fast? Is it just enough? I think for some people it'll work out. I think for others, they're going to be wishing they'd have done more or haven't done as much, but I don't know. I'm kind of a dork with it. I like to watch and keep Bloomberg and CNBC on and hear the experts argue and hear them argue a little bit and then turn it back to politics and hear them argue a little bit. So it makes it fun. So that's that with the main topic. I can go to question and answer now. If anybody's got any questions about anything real estate related or about the Fed decision, or if you've got your own ideas on what happened today, whether it was good or bad, let me know that too.
Yeah, just raise your digital hand, or if you don't want to speak, you can put it in the chat and I can read it.
Yeah, I haven't looked at the chat, so.
I haven't seen anything. Nerding out is awesome. Cheryl said.
Yeah.
Scary stuff. We got to stay above it as investors.
Yep. I see some hands, and I see Heather asked, "Will this help refinance?" Yeah, as the treasuries come down, it will help. I think over the next week or two, we'll see treasuries starting to come down a little bit. It will definitely help with refinancing. So, and I see Michael and Cheryl both have their hand up. Michael, looks like you were first. Go ahead. Looks like you're frozen though. So
Can you hear me?
I can. Yep.
Okay. My question is just like, when I'm looking for, I guess, my first deal, whether I'm putting it together myself or with a team, how big of a deal is too big for me to look at to try to get for my first deal, where I don't want to be like getting led on, like have a chance, but really they're not going to give me a chance to close.
Yeah. I'll kind of give you a little bit on what is required to get funding on a bigger deal.
Okay.
Now, when you're looking at commercial real estate, and this isn't true with all deals. So deals $1 million and more, I'll just say it that way. They're a little more lenient with deals under $1 million. But the deals $1 million and more, they want to see a net worth equal to or greater than the loan amount by the person signing on the debt. If you're buying, a $2 million deal, maybe it's, 25 or 30 units or 15 units, whatever it is. And you've got, some equity in a couple other properties and things like that. We can usually get you financed if you've got a little experience on smaller stuff. They like to see you stair stepping. So if somebody comes in and they, maybe have the net worth of 20 million and they want to get a $20 million loan, they qualify in that way. And let's say that their 20 million is all based on maybe a business they own and it's not real estate related. Well, then they're going to hold you back a little bit. They're going to say, hey, that might be too big of a deal for you right off the bat. So the requirements and things are really fluid. I would say that if you're looking at bigger deals, it would be very good to find someone that has done some bigger deals and bring the deals to them and partner with them on the first few. If you're looking at smaller deals, 1 to 10 units, let's say they're under $1 million. We can get you funding on those through private lenders. And they're not going to look at the net worth requirements as heavy. Now they will want you to have, 25, 35% of your own cash in the deal. They're going to want to, see that you have 6 months of reserves and all those types of things. And you can do those with partners. But, if you're wanting to do the bigger multifamily, I would say anything bigger than $1 million in loan amount, then, if you don't have the net worth requirement yourself, then you will need a partner to qualify there with that. So I hope that helps.
Yeah, definitely helpful.
And if you have any deals that you're looking at, you can always feel free to reach out, and I'll look at them and kind of tell you what we have available for that type of deal and what we would need to be able to qualify and things on them.
Awesome.
So yeah, for sure. No problem, man. Cheryl, I see your hand.
Oh, okay, I'm on mute now.
Yep, you're unmuted.
Hi, everyone.
Hey.
Good evening. Hope you guys are all having a good one. So I have so many thoughts going to my mind, but all right. So if we cut rates, it's not all that bad, right, for investors, because it just means that we might have more of the market share, or we might gain over it. I mean, if like
As
our home,
if you're a
our
current owner, you want rates to drop because that's going to raise the, as rates drop, expenses, your debt coverage is going to go up. You can borrow more money against the property, make some property more valuable. So if you're a buyer right now, I would say as a buyer, I'm telling the Fed in my mind, hey, keep these rates high, keep them high, keep them high, put these people in pain, and I want to get some good deals. And then lower the rates after I buy. That's what I mean, really that's kind of where you would want to be. As a buyer, you want to buy with the rates high, I think, because, with a 6% interest rate, you're buying at a 7 cap. The rates go down to 3%. Now you're buying at a 4 cap. And if the rates go up again, your property's now going to be worth a 7 cap or a 5 cap or whatever. So cap rates, kind of follow the interest rates. So if it's me, I like to buy with the rates high. And if the rates go down, then your property's going to have more value. Does that make sense?
yes, it does, because interest, it works opposite. If the interest is high, the debt's low, right?
Yep.
Like the yield measurement or whatever.
Well, yeah, if the interest rate's high, they can't borrow as much against the property, so it lowers the value. The values of properties is all based on what you can borrow on them. So.
I see. Okay, awesome. Thank you.
No problem. No problem. If anybody has any other questions, I'm going to keep going through slides. If you have any other questions, feel free to reach out on it with your hand raised.
There's a message in the chat from Corey. Do you want me to read it? Do you want to
Yeah,
read
go
it?
ahead.
He said, how much relief does the 50 basis points rate cut provide? How much more do you believe they need to cut to really see a correction in the market in terms of financing and investors pouring back in? Realistically, how much help do these operators with troubled loans get with the rate cuts?
Yeah, here, let me.
Both office or multifamily. What is your opinion on the future outlook of commercial real estate? Yeah,
So let me pull this up here. Computer's moving slow. Yeah, I mean, my outlook on commercial real estate, if you buy real estate that is cash flowing, um, you know, really you can't go wrong with it. I mean, you buy it with cash flowing, over time, real estate always goes up. If you look decade to decade, real estate goes like this. Now, year to year, it might go like this a little bit, but decade to decade, over the last 100 years, it's gone just like this. So if you can get property that pays for itself and you hold on to it, it's eventually going to be worth more than what you paid for it. So I don't never think real estate's a bad investment for that reason. So now I am screen sharing. Let me see here if I can. I'm going to stop screen share for a second. I'm going to share this screen. Can everybody see my new screen that's up?
Yes.
Okay, cool. So this property right here, let's say we have an NOI, the net operating income is $500,000. Enough zeros, yep. A $500,000 property at 5.5% interest rate, or let's go ahead and go, let's make this property a 6% interest rate with $500,000 of NOI at a 6% interest rate. Let's say this property was a 7 cap, so 500,000 divided by 0.07. So this is a $7.1 million property. Okay. With 30% down, that gives us an NOI of 1.39 or 1.4, or a DSCR of 1.4. We could probably even borrow 75% on this property. So we'd put what, 25% down, and that would get us to a 1.3 DSCR. So on this property at a 6% interest rate, we can borrow 5.3 million. Now this same property at a 5.5 interest rate, let's see where we would get to with the the 1.3 DSCR. So what, 28% down? All right, that's wait, 30%. I'm going the wrong way. So to get that 1.3 DSCR, what was our last loan amount? 5.1 million. Now with a 5.5% interest rate, you can borrow an extra 500,000 on that property. So, and with a 5.5% interest rate, now that property is a 6.5 cap. So it's a $7.6 million property. And we would then, put 25% down on that, which would get us to a 1.28. So 26% down. We just want, 5.6 million we could borrow on a $500,000 NOI. Now, what has really happened in the market is when interest rates kicked up, there was people that had bought a property with a 3% interest rate. And they had this 3% interest rate. They had $500,000 NOI, and they have a property at a 4 cap. So this property is worth 12 million when they bought it. Oh, shoot, down, okay. 3% interest rate, not down payment. So 30% down. So $12 million. going to get you. So that property with. So that property, they bought the property for 12 million bucks 4 years ago. It has a $500,000 NOI. They bought it at a 4 cap because they could get a 3% interest rate. They was able to borrow $7.5 million against that property. That same property now at a 5.5 or a 6% interest rate, they can only borrow 5 to 5.5 million. And the value is actually lower than what the loan amount is on this one. So this person right now, to buy that $12 million property 3 years ago, they had to put $4.5 million down on the property. And now at this point, their debt's coming due. If they had a 5-year loan on the property or a 3-year loan on the property, their debt's coming due, and they can only sell the property, for what they owe on it. And that $4 million that they borrowed from coworkers, friends and family, grandma and grandpa, aunts and uncles and cousins, that money that they loaned them or invested with them to buy that property is now gone. And so that is the situation that the rates increasing has put everybody into. So on a $500,000 NOI, it changes your loan amount by about $500,000. As the property gets bigger, the amount gets bigger, the percentage stays the same. So it's not really that big of a difference. This guy here, if he can refinance it, it's not going to allow him to refinance his property and get out of the property. He would have to put, if he owes 7.5 million, if he bought this, 3, 4 years ago, 5 years ago, and he bought it for 12 million, his loan amount is 7.5 million. He probably hasn't paid much of the principal down because he was on an interest only, generally speaking, because it gives better cash flow. Now he's stuck with, I need to go to my investors and see if they can give me another 2 million so I can refinance this turd that I've bought. Or I just need to tell my investors, I'm sorry, I've got to sell the property before my loan runs out, because the bank's just going to take it. So that's a situation that people that bought within the last, anywhere from 3 to 7 years ago, if they bought properties, most of them are in this situation right here. So I hope that helps you understand a little bit. When you were asking about what is the half a point going to do, it's not going to do much. The big thing it's going to do is give people confidence that we're going in the right direction. That might be what it does. I don't know. But share again, share my slides. So hope that answers the question a little bit. Can everybody see my screen again? Things we need for a quote. If you want to get a quote on a property, send us T12, rent roll, OM if you have it. A summary of what you plan to do with the property or what you're thinking. If you've done some underwriting, if I plan to offer 4 million, they're asking 5, whatever it is. Things we'll need as we move along in the process: SREO and PFS, schedule of real estate owned, personal financial statement. Those are things we'll need before we go under LOI. If you don't have those things that qualify, then you need to have a partner that does.
Can you see your chat?
Let me see. Can now. So, okay. So somebody said Corey said, are these adjustable? Though not fixed debt. So a lot of if you're going into long-term debt and you get a 5-year note, it's going to be 30-year amortized generally. And then you're going to have a 5-year term where the interest rate is locked in. After that 5-year term, it will go adjustable. The thing is, when it goes adjustable and the interest rates have gone up by 4 points, when it goes up that 4 points, the property is no longer cash flowing, generally speaking. So when it's no longer cash flowing, a lot of the lenders will have a DSCR requirement on the property. So you've got to maintain a minimum of a 1.2 or a 1.25 DSCR while you have the property. If it goes below that, it goes into a default, and the bank will actually take a property back if you go into default, with your cash flow. So we know someone that lost a property 2 years ago that went adjustable. $55 million loan, $70 million purchase, had 20-something million in investors' money in the deal. The property went into default by way of the DSCR not being covered when it went adjustable. And the bank took the $50 million property, or took the $50 million note, took the property, and then sold it to somebody else. So this guy had $20 million of investors' money that just vanished overnight. So that's what the interest rates kicking up has done to property owners. So what can you do today to make sure that you are ready to be, if you are not ready yourself to buy one of these properties, you've got to connect with someone that has bought these properties and is willing to partner with you. They call that a key principal, or a KP. But what can you do today to make sure that you can be a KP in the future? Make sure your credit's in order. Start working on your personal PFS and SREO. Get your bio together. You got to get some experience managing some property and being on deals. Whether that's I heard somebody say they had some money in with Grant. That's good, because you start seeing how the properties are run. You're seeing his reporting. You're on the calls, hearing what they're saying about the property and what they're doing. That's all good experience that you can put in your bio. If you invest 5 or 10,000 with Grant, and he buys a 200 unit property, you're now a lending partner or an LP on 200 units. That's something you can put in your bio, or with anybody. So work on raising capital or making more money. Start talking to people about what you're doing. Another way to make money is our referral program. Refer business to us. If we close deals, we pay referral fees. Today's verse, Malachi 3:10, bring the whole tithe into the storehouse, that there may be food in my house. Test me in this, says the Lord Almighty, and see if I will not throw open the floodgates of heaven and pour out so much blessings that there will not be room enough to store it. So this is about giver's gain. So if you give to God and give to his purpose and give to people that need it, then he'll make sure that he gets it back to you. Our pastor always says, if God can get it through you, he'll get it to you. So, and we live by that ourselves. So our next Zoom topic, October 2nd, is all about construction and rehab financing. Here is a link to the Freedom Chasers WhatsApp group. You can scan that QR code and you join the group. And there's some big name real estate investors that are part of the WhatsApp group and active in the group. So Michael Blank has been on there and posted on the WhatsApp chat. So if y'all know who Michael Blank is. And here's our contact info. That is my Hi Hello card. You can scan that QR code and you can send me your info and I'll have it in my phone. And then you'll also have all mine. That is my cell phone number and mine and Shelly's emails. And make sure you join the community and be on all these calls. Quite a few people on this here. I know Trevor's part of several deals. I think one in Knoxville. He's got another one somewhere else. BB and Iffy have been buying deals all over the country. And Ed and Kevin have been buying deals all over the country. And they're both active commercial brokers. So connect with everybody you can connect with on here. And thank you all for joining tonight.
Thank you, guys. I will leave you with some music.
Thank you.
Thank you. Y'all have a great evening.
Thank you guys so much. You
For
too.
sure.
Awesome company.
Can you hear my music?
Can't hear it.
Hey. Hear it perfect on this side.
And you're cutting out too. Okay. Well, you all have.
Bye, guys. Thank you for
See y'all.
joining. See
No
you guys.
music tonight.
Thank you. Thank you. Thank you.
Yeah, you're welcome. Have a good night.